Hey everyone, this is Dan Russo, the Chief Market Strategist at Chaikin Analytics, coming to you with a few charts that I'm paying close attention to as we head into 2020. The first chart here in the top panel, we can see the 10-year U.S. Treasury Yield Index, and it's interesting to me that the 10-year yield bottomed in September and has now made a series of higher highs and higher lows as it begins to work higher. Now, we could see some resistance at the 2% level. However, the dynamic that I'm watching closely to guide my view on the 10-year yield is actually the chart at the bottom of the panel here. This is the copper to gold ratio, and we can see that throughout much of 2019, copper was lagging gold as investors were concerned about global growth fears. However, since September, right around the same time that yields bottomed, copper has actually been outperforming gold. And what that says to me is that investors are becoming less concerned about the global growth picture. So I'll be watching the copper to gold ratio very closely to inform our view on the potential path of 10-year yields. And to the extent that copper continues to outperform gold and 10 years yields continue to move higher, I think there's scope for financials to continue to work. Taking a look at the Financial Select Sector Fund, the XLF being the ticker symbol there, we can see that right around the same time that yields started to move higher and right around the same time that copper started to outperform gold, the financials put in an important bottom and have been working higher. Back in the October timeframe, right around the same time as the market, the financials broke above near-term resistance and have continued to work higher. All the while, the RSI, the relative strength index, has made a series of higher lows as it has shifted into bullish ranges, giving us an indication that momentum is confirming the price trend. And then if we look at financials on a relative basis, we can see that they have broken through resistance, have held up to a subsequent test of that resistance here in the November-December timeframe, and are now outperforming relative to the broader market. So we have scope for financials to continue to work if yields move higher, as long as copper continues to outperform gold. And if all that continues to play out, we think an area of the market that really could do well in the start of 2020 are the banks. Taking a look at the KBE, the SPDR S&P Bank ETF, we can see that this ETF has a very bullish Chaikin Power Gauge ETF rating. And if we look under the hood at the individual holdings of this fund for their Chaikin Power Gauge ratings, 59 stocks have bullish or very bullish ratings, and only one stock has a bearish rating. From a technical perspective, the fund was really moving sideways throughout the majority of 2019 before breaking decisively through this $46 level recently. At the same time, the fund appears to be under accumulation as the Chaikin money flow indicator is bullish, and importantly, is relative strength. And we can see that the banks were an underperformer relative to the market throughout the majority of 2019. But at the end of October, right when rates started to move higher, the banks started to see improved relative strength and are actually outperforming relative to the market. So as we head into 2020, what I'm watching closely is the copper to gold ratio to get a gauge on how investors are thinking about the global growth picture and what that means for the 10-year yield. To the extent that both that ratio and yields move higher, we think that there's scope for the financials to continue to outperform the market, and in particular, the banks, the KBE S&P Bank ETF with a very bullish Chaikin Power Gauge ETF rating, 59 bullish stocks, one bearish stock. We think that this is a fund that can continue to work, and something we'll be watching closely as the new year gets underway.
Welcome to Power Charting. This is the 2020 Outlook. As we are going to take a few minutes and we're going to look ahead at 2020 from a Wyckofian method perspective. We are reviewing, in fact, a 2019 chart, and here we can see that 2019 really began with a buying climax at the beginning of 2018, automatic reaction, range-bound condition, and then with an upward tilt to the structure, not uncommon. And so we can see here that this upward tilt to the market and to the trading range has been in force. I want to show you this trend because this very well could speak to what could be coming next in the markets, because this was the end of the 2016 reaccumulation area and a really robust uptrend. We believe something similar to that is occurring right now, and that we're already seeing this market wanting to commit to a new uptrend at the end of 2019. So very exciting. So looking at this, again, this is the third turning, which is a discussion we had about 2019. This is the 2016 reaccumulation area, 21 months in duration. We're already at 22 months, but we're committing already to a new uptrend. This chart was done at the end of the second quarter. And so you can see here that we have been 18 months in, now 21, 22 months, starting to work our way out of this reaccumulation area for the third turning and the potential of a great upward trend thereafter. So let's look at some point and figure charts with the time that we have left. And so here you can see the second turning, which we did a point and figure chart on. Well, look what happened. Went right to 2960, 3140, missed the 2960 box by one box. So very impressive, and it did touch that box right here. So now we have additional count up to 3140, and we have, if we take the larger count, 3,800 to 3,980. This is S&P 500 index counts. And so this confirms this yellow box. We take a partial count of this area, takes us 3,620 to 4,000. So in fact, there is a great count, accumulation count, that is driving the market upward and takes us to this 4,000 area, which would be a very important rally phase in the market. So if we take both of these count areas, it takes us to an even larger count of 5060 to 5440, material increase in the value of the S&P 500. And this all comes because of this third turning, this long resting phase that has lasted 22 months or more. So a very important uptrend could be in the offing, and the S&P 500 and the other large indexes are already committing in that direction. So it's very exciting. One last look at another chart. This is an area that we think is going to get some attention in this important rally phase, and you can see here that the Dividend Aristocrats, which is an ETF, is already in its uptrend and has been going for a period of time. Well, notice this count. This count goes up to the 9044, 9576 area, which is the count of this range, which is very similar to the one that we just looked at for the S&P 500. This count gives us a 26% potential appreciation just from here. So very exciting. We'll keep an eye on this in future episodes of Power Charting, and we'll see you sometime soon.
Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. 2020 is just around the corner, and today I want to highlight a stock that could be poised to move. We're going to go over three things. First, there's an overall bullish theme at work. Second, we have a Bollinger Band contraction, which means price action has turned very boring. And third, and most important, we're going to look at the structure of the price chart, because at the end of the day, price is what really matters. Let's take a look. So when we're thinking about a long-term theme, this is a fundamental theme, and so it is subject to change. And as I said, price is the ultimate driver of our decision. But if you look at the long-term themes for Amazon, it is of course dominant in the retail with Amazon.com. And then it is also building into the delivery business, and it is expected to have or deliver more packages than UPS or Federal Express by 2022. And then the third and perhaps biggest driver is AWS, which is Amazon's cloud service. It was dominant in 2017 and 2018, and soon we will see the numbers for 2019. Now, what first caught my eye with Amazon on the price chart was this Bollinger Band contraction. And you can see here that bandwidth has narrowed considerably over the last 12 to 18 weeks here, as price has pretty much gone flat around that 17 to 1800 area. And if you look at the last time this happened, it was back in September, October 2017. So you had a very boring price range and consolidation, and that gave way to a breakout and a strong move higher. Now, one thing you got to remember about Bollinger Bands is they don't give us any directional clues. All right, when they're contracting, that's telling us that volatility is contracting basically. And Bollinger theorized that you would get a volatility expansion after that contraction. And so that's what I'm looking for. But as far as direction, we have to turn to the price chart, which is next. So what I'm looking at is what is the structure of the price chart? What are the structure of the movement? Is it an overall bullish configuration or not? And the first thing I see here, because we got to work from the left to the right, is we've got a huge advance in 2017 and into the first half of 2018. And then we've got basically an 18-month consolidation here where price has moved flat. But what's happening within that consolidation? Well, basically we had a correction in the first part, and then we had a breakout above the channel trend line and above this resistance zone. And what I think is very interesting is you can see resistance turning into support and holding in the middle of 2019, and then throughout the last few months there's a clear support zone here as price consolidates. So I think it's consolidating and preparing for a move higher, because I think this is an overall bullish construction, because you have the big move, a consolidation within an uptrend, and that favors a breakout. So if you get a breakout at 1840, you're back above the rising 40-week moving average, and I think that opens the door to new highs for Amazon. And on the PPO, you can see if it turns up and breaks its signal line, that would be the first signal that momentum is picking up. So there you have it. Amazon, one of the most exciting stocks in 2017, has turned boring the last 18 months, but it is one we should watch heading into 2020. Thanks a lot for tuning in, and Happy New Year.
Hey everybody, it's Greg Schnell. I'm here with my 2020 outlook, and I think the biggest thing that we'll need to consider over the next year are the major trends in currencies, which will be worth listening to. I'm going to quickly jump over to the US dollar, and the point I want to make is the US dollar has been pretty informative for us over the years when it wants to change trends. And so we had an Asian financial crisis which dipped it here, but you can see that the market pretty much topped out here, and then in late 2001, 2002 started to roll over, and on that rollover, that kind of really marked the acceleration down into the final lows. But as the top was being constructed, this market broke down. So as we built the top, it broke down. Then in 2008, we kind of hit the bottom in the currency, and what we saw was the stock market accelerate lower. Now we've got a big 8-year trend up and this big downtrend line here. So between, I'll call it 95 and 100, we have this narrowing in, maybe even 94, but somewhere in that range. We want to watch for that. I think if that breaks, that's a big deal. Going to the next chart, the Canadian dollar, you can just see is starting to break this 7-year downtrend here. So I think that's pretty important. On the other hand, if it breaks the 5-year uptrend, that would be equally important. Looking at the Australian dollar, there's an 8-year trend here trying to break, and you got this really big horizontal support level pretty much right where we're at. So I think we're going to expect some changes in the commodity countries. Looking at the British pound, got this huge downtrend going back to the '07 highs, and every time that the British pound turns down, it makes a meaningful change. So a bottom, market started to consolidate sideways for almost a year, started to consolidate sideways, finally a big breakout, and off we went. In here, it marked kind of a 6-month swagger, then it marked the top here, and then a big pullback. Here it marked another breakout, here it marked another top. Here it marked another breakout, and now we've got another signal here. So watching the British pound quite closely. The euro, we have a big 10-year downtrend and a big 20-year uptrend. One of these is going to break this year. Anxious to see which way this goes. So with all of that, one more to cover off, the yen. The yen has lots of interesting twists on it, but I think the biggest thing we want to watch for is this 7-year downtrend and 5-year uptrend. If this starts to break, I think that's a meaningful trend change for us, and the yen has lots of signals on here I don't have time to get into, but I think the currencies are definitely setting up for a big year this year, so stay tuned. Thanks everybody, have a good year. If you'd like to learn more about my stuff, gregschnell.com. Thanks everybody, bye-bye.
Hi, this is Mary Ellen McGonagle with MEM Investment Research. And today I'd like to review with you an area of the market that's been a real outperformer in 2019. And it's a sector that I anticipate will continue to outperform into 2020. I'm talking about technology. We're looking at a daily price chart of the sector chart, and we can see it's been, for the most of this year, in a clear-cut uptrend, a real leadership group. In fact, it's up over 45% year to date. And that has everything to do with the underlying stocks within technology. A lot of cutting edge technologies are being brought to market and being met with very high demand. They are improving productivity for a lot of various industries. So I'd also like to drill down to some of the technologies that are being embraced and will be rolled out next year. And there is an area known as connected and intelligent environment. And we can take a look at a couple of the underlying technologies. One is known as digital twinning. Quite simply, it is a digital replica of a physical asset that's created. And that asset is normally going to be a multi-million-dollar type of machinery. And what management can do is better monitor and analyze that asset. They can also tweak it using that digital replica. And if those changes are productive, they can then go ahead and change that large physical asset. And it's really saving companies millions of dollars, not only in the modifying of that asset, but also in improved productivity and profitability. Another area that we can take a look at is physical tech. And this is a revolutionary shift in the human to computer user interface, and it's really changed the way that businesses design, manufacture, and sell their products. And both of these are part of several new technologies that have been in development for some time, but are now being more widely utilized by companies. Let's take a look at some of the bigger companies that are in these two areas of technology. One we can look at, of course, is Apple. Apple really helped introduce and mainstream that physical tech, and that was through voice, facial, and speech recognition. Another company not as well known, ANSS. This company actually provides the platform that allows these managers to analyze those assets. And then Microsoft, another large firm. This company has been bridging that physical and digital worlds for some time now, and it really is a continued growth area for both Microsoft and Apple. Jabil is another smaller company that is also in these newer technologies. These are just some of the many companies that in technology that are poised to take advantage of the continued growth in these cutting edge areas. Now, I don't want to leave this theme without taking a look at a critical component among these and all new technologies, and that's semiconductors. Semiconductor chips and those companies that provide machinery to create those chips, these are enabling all of the advances that we're seeing in technology. We can see this nice uptrend going into year end. This is SOXX, the ETF for semis. And I anticipate this group to continue to outperform into 2020 and beyond.
As we stated before, our Wyckoff story is all about bullish outlook for 2020. And I walk you through the analog from the 1999-98 on the composite. We will come back to this analog. But firstly, let's see where we are as of now. And we're kind of bouncing around the trend line and around the resistance of 32, 32.50. And we still have quite a lot of room to go. So if we are successful at staying at this level, currently I would be expecting the continuation of the rally into the 3,500 target, which was confirmed by both counts, the campaign count, which we have taken from the phase C shakeout and test, and throughout the whole structure in 2018 into the automatic reaction. And then the second confirming count, 3,500, is on the backing up action. And the backing up action happens at the top of the channel. So this is really important spot where we see the price is being supported by some of the local absorption of the supply and suggests that the same target is possible, 3,500. So that's our first assumption as to what we're going to see in 2020. But then let's come back to our analog, which is the historical analog of NASDAQ Composite from 1997 to 2000, and we're comparing it to 2017, 2020. And obviously we're projecting what might happen in 2020. Why would the analog work? Well, because specific conditions of liquidity and specific conditions of rotation and sometimes even events, the way how the Fed reacts, the way how the monetary policy unfolds are very similar. We had a mid-cycle easing by the Fed in 2019. We had the same in 1998. Granted, it was related to the Russian default and some other events at that time, but the environment is extremely similar. And when we look at the structure, price structure, that is, the price structure is similar as well. We see that there is an original trading range that has a shakeout action that is so similar in both cases. And in both cases, we see how the rally out of this extreme oversold condition is extremely aggressive. Institutions have been buying in both cases, and their buying have been extremely aggressive. Then after that, we have a sloping up structure. And I think that in our case, in 2019, 2020 case, we're getting out of this structure a little bit faster just because the buying in 1999, 98, 99 was a little bit more aggressive. So suggestive of more of a pause after such profitable rally. Well, where could potentially we could see that run go? On NASDAQ Composite, obviously, growth-oriented index with a lot of high momentum flying stocks. In 1999-2000, it was a spectacular rally into the top to over 5,000. And our expectation is that the conditions are such that we probably could expect the same character, not just bullish, but aggression. And we kind of see this at the beginning of the current rally. So that's our assumption that in 2020, going into 2020, our first rally is going to be aggressive. It's going to be a historic rally. And we definitely have to make specific trading decision to reflect that. Well, in terms of the targets, and I've shown this before as well, the whole structure dictates two targets, 3,500 or about, and that is again 2 targets that were confirmed by 2 different counts. And then this is something new. This is something that I wanted to show at the end of the year. We have a most aggressive count where we take the count through the whole trading range on a much higher line rate here. And it leads us to over 5,000. And this is a very interesting target, because if we're going to have an aggressive rally, we're probably going to move to higher targets rather than the intermediate targets. So 35 seems to be a really good intermediate target, but we definitely need to think about the character of the rally that is to come, and 5,000 seems to be a reasonable number based on the historical analog from 99 and 2000. What about NASDAQ? Well, NASDAQ has a very beautiful 10,000 objective, which is the campaign segment number 1. We could see it here. And then the second big target through the whole structure would bring us to 16,000. Well, that's a little bit too much to think about right now, because, we're just, below 10,000. So it's really hard to imagine. But when this type of rallies actually occur, they require a lot of force and conviction of a lot of market participants, and that conviction happens as uptrend unfolds. So more and more participants would be going in and buying into this rally. Well, the analog from 1998 and 99 had a count that led us to and suggested a target of 5150. And please note when we're taking the count. We're taking the count at 2650. So again, it's really hard to imagine at this point of time at 2650, at 3000, even on the breakout, that we're going to reach that high. But the actual intraday high reached on March 10th of 2000 was 5132, which is a damn impressive proximity to the original target. So with that, I want to wish everybody a happy new year, and we are looking forward to seeing how the market is going to unfold. As usual, we're going to be looking at the technical analysis and Wyckoff method in the guidance of the markets. Thank you.
A prediction for 2020. I wish I had 2020 vision for 2020. But you know what? Talk to me in 12 months' time, and I'll have 2020 hindsight for you. As you know, looking back is easy. Looking ahead is much harder. And ain't it funny that almost all technical analysts, trend followers, agree that predicting the future is not possible and probably a waste of time. We all claim that we monitor the market and try to detect trends and adapt our strategies or opinions based on the information that the market provides us. And yet, here we are. Once a year, we go with the flow and try to predict. What I'll try to do is try to paint a longer-term picture that is built on current long-term trends, which I think are currently in effect and which may continue to play out as we go into the first few months of 2020. Anything beyond a few months, maybe even weeks into 2020 will probably be a real gamble. Obviously, my main weapon of choice will be the relative rotation graph, while price charts combined with relative strength are my sidearms. So let's go. From an asset class perspective, the rotational picture is pretty clear. Stocks are still the preferred asset class. They continue to move at an RRG heading around 90 degrees, maybe a little bit less, and they remain around the same RS momentum level. This sort of rotation indicates that a stable relative uptrend against VBINX, the benchmark, the Vanguard Balanced Index Fund, is underway. At the time of recording this video, the daily rotation for SPY just completed a stint through weakening and returned into the leading quadrant, which adds new fuel for a continuation of this relative uptrend for stocks going into 2020. Now, if we go back to the weekly RRG, we see that all fixed income related asset classes and real estate are inside the lagging quadrant. And they are all pushing further to the left, which in RRG terms means that they continue to lose relative strength, they continue to lose power. Commodities could be the outlier and the surprise for the beginning of 2020. On the weekly RRG, DJP is inside improving, but dropping almost vertically on the JDK RS momentum scale. That is not very promising. And with a position at the 100 level of the RS momentum axis, a return into the lagging quadrant seems very, very likely. On the other hand, DJP is showing a strong rotation on the daily RRG. And on that one, it recently entered the leading quadrant at a very long tail and the highest RS momentum value in this universe at the moment. The increase in relative momentum is leveling off right now, but the power is certainly there on this time frame. So for me, the big question for the first few weeks or months of 2020 will be whether the current strength and improvement in commodities will be able to turn around the long-term relative downtrend that is characterizing this asset class since 2008. I don't feel very comfortable yet making a call or a prediction here, but I will keep an eye on this rotation as it might just be the move that a lot of people have been waiting for ages, and that's almost literally for ages. We go back to the big picture. All in all, it's very hard to get a rotational structure that is more bullish for stocks going into the new year other than the one that we are currently seeing. So going into 2020, my preference remains with stocks and avoiding fixed income and real estate while keeping a close eye on the rotational development of commodities. I hope that all of you are having or had a great holiday season, and I wish everybody a very happy and healthy new year with 2020 vision for all your trades and investments.
Hi there, my name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. Excited to give my part for the 2020 market outlook. So looking at the charts here, there's by any definition, the market feels very extended here, and the best way I know to measure it is by looking at the daily RSI. And an RSI above 80 means the market is extremely overbought, meaning it's gone so strong to the upside, such positive momentum, you'd expect a bit of a pullback before one final move up. So while it's difficult to project what the end of 2020 is going to look like, I'm pretty sure the beginning of 2020 is going to feel like a little bit of a move higher, but I feel like it's going to be more of a last gasp higher as opposed to a next leg higher as the market attempts to digest the gains that we've had in the fourth quarter of 2018. I think the second chart here sort of illustrates why that might be the case. This is looking at breadth in the form of the percent of S&P 500 names above their 200-day moving average. You can see we're just above 80. We're at 83% here the last week in December. The only other times in the last 5 years that it's been that high is the beginning of 2018, the beginning of 2017, and the middle of 2016. Each one of those three times resulted in a brief to longer pullback, some more steady and shallow like 2016, some relatively severe like the beginning of 2018. But this lines up with the breadth characteristics of previous bull market tactical, if not cyclical tops, which is why I think the first quarter we're going to feel a little more pain than we've had in the fourth quarter of 2019. Now the third chart is looking at the dollar. The rest of the time I'm going to be thinking a little bit about international markets, and I think one of the biggest potential thematic changes we're going to have is a transition from a strong dollar environment to a weaker dollar environment. We've potentially seen the beginning of that in the second half of this year. So you saw this slow and steady uptrend in the dollar index. You saw corrections or pullbacks in the dollar at the end of 2018, again the summer of 2019. And in the end, in October of 2019, we saw a similar pullback. It was a very similar trajectory to the first couple times, but you can see that we did not resume that uptrend. We've now transitioned from a period of higher highs and higher lows to a period of lower highs and lower lows. We failed at Fibonacci support. We've broken down through the 200-day moving average. The dollar is now sloping downwards below 2 downsloping moving averages. The RSI did not get above 60 in the last couple months. And so overall, that transition to a weaker dollar environment, I think, is going to be a very different theme than many investors are faced with. And I think it might cause this ratio to go down. This is the ratio of U.S. stocks in the form of the spiders versus global stocks in the form of the ACWI, All Country World Index. So that's about 50% U.S., 50% non-U.S. Arguably, this ratio has had a double top, a peak here in August, a secondary peak here in November. We're now potentially starting to roll over. It's early days. This is not broken down yet. But if that dollar continues to weaken, in general, the U.S. tends to underperform global stocks. And if that continues, I think a lot of investors will be caught underexposed to international names at a time when it arguably could serve them the best. To finish out my 2020 market outlook, I'd look at this ratio. This is emerging markets versus developed markets, so EEM versus EFA or EFA, which is global developed markets, developed Europe and Asia. And this ratio has been in a downtrend for most of 2019, right? As commodities struggled, as oil was weaker, emerging markets tended to underperform developed markets, but that ratio has now broken to a new, potentially a new 6-month high. It's definitely a new 4-month high here in December, but it's rallied significantly after being at an extreme weak moment, now in a position of strength, testing a new 6-month relative high. That's driven a lot by these last two charts. This is the chart of commodities. This is a GSCI commodity ETF, and this is in a position of strength now. So we had a downtrend, and using a trend line using the highs from 2018 and 19, we broke above that, had a resistance level around 1620. We've now broken above that resistance. This is a transition from distribution to accumulation. It's overbought here at the end of the year, where you'd expect a little bit of a pullback similar to stocks, but overall I think the trend has reversed and we're going to see strength in commodities. That's going to buoy up emerging markets relative to developed markets. And the final chart I will leave you with is the chart of gold. This is the 2 to 3 year chart of the gold future, the continuous contract. You can see that this has found support at a Fibonacci support level, now breaking above interim resistance and now in a period of higher highs and higher lows. And I think strength in gold is another potential safe haven that a lot of investors are not where they're not, and they potentially should consider allocating to. That is my 2020 market outlook, thinking about potential weakness in stocks in the first quarter, the emergence of commodities weakening in the dollar, and what that means for U.S. stocks versus international stocks. Have a great new year, and all the best for 2020.